Hello, ladies and gentlemen. Welcome to another live stream. Welcome, everyone. Hope everyone's having a good day so far. Where's everyone tuning in from today? Let me know in the comments down below. So I'm not going to be live streaming now. What I am going to be doing is showing you guys the strategy that I trade. Just give me a sec. I just want to edit this really quickly. For whatever reason, I'm not signed in. So what I am going to do is show you trades I've taken last week. I'm also going to be going through the strategy that I trade, but more in depth. So we're going to talk about the confluences I use when I trade, because that's really important. It's one of the most important things. So when I am trading this strategy, there are 5 different confluences that I make use of that helps me get into high probability trades. Without them, it's pretty much useless. You may as well just be entering random places on the chart. Give me a sec here. Why are we... Okay. Just give me a sec here. For whatever reason, my Miro is not working so good. I'm not on this. For whatever reason, I can't edit this, but it doesn't actually matter. Okay. What's going on, Meg? Skiwood. What's going on, guys? So today I'm going to show you guys the strategy that I trade. I'm also going to go over some of the confluences, which is the nuances of the trade strategy that I trade, which is really important to understand, because without that, let me just fix this real quickly. I don't know why it's doing that. Because without understanding the confluences, getting into trades becomes lower probability. So the way that I trade is really simple. It's just a simple break and retest strategy, right? So we're looking for very specific criteria to get into a trade. It's pretty mechanical, okay? It's really mechanical. There are, however, some nuances which come in the form of the 5 confluences that we look at. And once you understand these 5 confluences, they are you're able to spot high probability trades when you're using these mechanical rules. So let's first go over the simple mechanical rules, which I'll show you really quickly. So the simple thing we're looking for is the breakout of a range. So you've got a range like this, and we're looking for price to either break and close above or break and close below either of these 2 zones. Once price breaks and closes below, so over here, we can then look to take price lower. If price breaks out and closes above, we can then look to take the retest and take price higher. It's that simple. So here's your range here. You would look for price to break and close below over here, retest, and then go lower. That's my entire model explained in a couple seconds. So Similarly, if we're looking for buy trades, we would look for price to break and close above this level. We would then look for price to retest, and then we would take price higher. So how do we spot these zones over here? Well, I'll show you the exact criteria I use for them. It's very replicable, and it's easy to spot if you follow the rules to finding them. That's the first step, is understanding how to spot these levels. Once you understand that, you can then trade the system effectively. Then I'm going to show you the 5 confluences to trading the strategy, which gives you the highest strike rate. Because if you just trade these blindly, you won't have a very good strike rate with the strategy. So let me show you that real quick. Right. So like I was saying before, firstly, the breakout strategy that I trade, these are the pairs and timings that I traded on. So you guys can see I use the NASDAQ and all trading futures NQ, right? So a lot of you guys are trading futures. Obviously, we're here on GuardianTV. So if you want to trade futures, one of the best prop firms to trade futures with is Blue Guardian. Reason being, they've been around for a heck of a long time now. They're trusted. They've got good reviews, and they have a track record of actually paying clients out. That's the really important thing. The other nice thing is the pricing is decent. You have pricing that reflects what you get in the evaluation. Whereas other prop firms, it's either so cheap that it's sketchy. You don't know if you're going to get paid out. How are they going to pay you out if their evaluations are so cheap? And the rules are so easy that you wonder, am I going to get paid out? With Blue Guardian, you've got a track record of actually getting paid out, and the rules are not so complex that you can't follow them, right? So they've got a good track record. That is the main central thing you look for when you're trying to trade with a prop firm. So I trade NQ futures, or you can trade NASDAQ if you're trading CFDs. And then I trade that at the New York Open. So I'm only looking at ranges at New York Open to trade. You can also trade on German 40 or the DAX. You can also trade on GBP, JPY using these times. But today I will focus on NASDAQ. Okay. Yes, I didn't add it to the screen. So yeah, you can see here on the screen, you can take a screenshot of these if you want to get the timings and the pairs. So you can go back in this if you want to see it. So this is how you determine a trade is valid or not, okay, in my strategy. So to identify, you can look at 4-hour key zones, first of all, which is a really important thing to do. You basically do not want to be taking trades into these 4-hour key zones that are marked out. And you simply mark them out by looking at areas where price has bounced multiple times on the 4-hour. Okay, you mark them out on the chart. Okay, I'll show you examples of that. However, the most important part is identifying the 5-minute ranges. Now, the 5-minute range is simply identified by looking at after 9:30 open. You are looking for a place where a price has bounced multiple times on the extremities. So you can see prices bounced here, here, and here. You can see here we have reacted multiple times in and around this area on the 5-minute time frame. Okay, multiple times. So these candles here that have reacted multiple times in the last half an hour, I like to call them buddy candles, because we've pushed in and reacted, pushed in, reacted, pushed in, reacted, pushed in, reacted. Okay, this is a very strong zone. So once we break and close above, we have a very good high probability setup. Now, the next thing we look for is for a break and closure, and then also confirmation, which is that we want the 50 SMA to be below price if we're taking buys, like in this case over here. And if we are below the 50 SMA, we can then take sells. Okay. Price must break and close. Okay. So if you look here, this candle closed on the 5-minute time frame. We then wait for price to retest that zone. Okay. Then we observe the 5 confluences, which are what I'm going to teach you today. Okay. This is how we can determine whether it's a high probability setup or not. Can you guys all see the screen? What's up, Daryl? Just let me know if you guys can all see the screen and everything. You guys can hear me good. Now, if we look at this particular example, you can see here, we broke and closed above, we retested, and we pushed higher, okay? We did actually hit take profit on this example, okay? Now, how do we manage these trades? I'll show you now. We enter on the retest, right? So you can see price broke and closed, it retested, went a little bit lower, and then continued higher. We wait for a bit of a hesitation when it retests. Generally, I skip the hesitation part unless we have extended further. So if price has pushed up here before coming to retest, then I'm going to wait for price to start to reject, especially if it's come down with quite a lot of momentum. However, if we've just broken above like this, I'm cool to just get in as soon as it retests. Then we want to manage it as follows. We want a 1 to 2 risk reward ratio. And on NASDAQ, I use anywhere between 20 to 30 points as a stop loss. Okay. And this is dependent on the previous volatility. So how I determine my stop loss is as following. I look at the most recent candles. Okay. And I measure them. So I can't do it on this image, but basically these candles would have been in and around 20 points. Okay. And if you look at the most recent candles, you can see they do not get bigger than this candle. And so I set my stop loss to roughly, I think, 25 points on this, which would mean that my take profit is around 50 points. That's how I determine my take profit and stop loss. So essentially, that's how I manage the trade. And when it comes to managing stop loss, when I get to 1 to 1 risk reward ratio, which is around halfway to the target, I then put my stop loss at entry, and then I go for the full 1 to 2 risk reward ratio. However, there is another way you can manage this, and that is by simply using a 1 to 1 risk reward, which is what I often trade. So I will have a stop loss the same size as my take profit, and I won't go for 1 to 2. I will just simply take everything off at 1 to 1. Now, the way that I manage my accounts is as follows. When I am doing prop firm evaluations, I'm going for 1 to 2 risk reward ratios. Why? Because with my data, it has a higher return when I hold trades for 1 to 2. Okay. Now hear me out. Why wouldn't I just take 1 to 2s all the time if it gives me a higher return long term? Okay. And the simple answer is when you're doing an evaluation, you aren't really that attached to that account. You haven't passed that account. Okay. You haven't put time and effort. And really, a lot of the time, the accounts are quite cheap. So you're not that worried about it. But once you've passed it, okay, so holding these trades to 1 to 2 risk reward ratio is easier to do in the evaluation stage. But when you're past the evaluation, you're wanting to take small base hit trades to consistently make profit so that you can, number one, stay within your consistency rule constraints, okay, for prop firms. And number two, just get some money in your pocket because you want to consistently bag profits so that, firstly, mentally you're good because remember, trading is mostly mental. So if you're taking 1 to 1 trades on your funded account, you're more likely to have a successful trade psychology strategy. Okay. So for me, when it's on a funded account, I'm going 1 to 1. When it's on a evaluation, I'm going 1 to 2. And I manage them as such. I do have funded accounts that I go 1 to 2 on, but that's because I have multiple of them. So I manage them like that. Yeah, Samantha. So if you're able to do that, it is beneficial because firstly, you don't get FOMO. Okay, so what often happens within our trading community is people get FOMO when, for example, the trade only goes to 1-to-1 risk reward ratio, and then you put your stop loss at entry and you walk away with no profit because your stop loss hits you at entry. Now, you might think, oh, I didn't lose anything, so it's not so bad. However, when everybody else has taken profit off the table and they're posting profits, you're going to get FOMO. So the way that I avoid FOMO is I have multiple accounts with multiple take profits. So I know at the end of the day, I'm walking away with something, and I'm walking away with a 1-to-2 on one account and a 1-to-1 on another account. So I'm always walking away with something, unless it's a stop loss. Again, like my trade psychology and me as a trader, I was not a super advanced trader when I started out trading, same as everyone else. Okay. I struggled. I was a big time gambler when I started trading. My mentality was that of a gambler. The way that I navigated it is actually not by a whole lot of self development. Yes, there was a lot of self development involved, right, in my journey. But to be honest with you, the way that I circumnavigated the mental game of trading is by creating these mechanisms of getting around these psychological problems. So, like I was telling you, you got FOMO, okay, have multiple accounts and take profit at different areas. Okay, you've got greed issues, okay, only trade once a day. So, if you've got greed in your trading, commit yourself to only taking one trade a day max. Because, like I mentioned in our last session, if you've got 24 hours between every trade you're taking minimum, if you take a winning trade now, what's going to happen to you is you're going to get on a little bit of a dopamine high. And that dopamine high is going to trigger you to later on perhaps making a reckless trade decision. That reckless trade decision could be getting into a trade that doesn't meet your criteria. Or similarly, if you take a loss, you're going to be on a low and you're going to want to be chasing a high, right? You're going to be wanting to get out of that loss. The only way that you prevent yourself from doing that is stepping away and coming back tomorrow. And so if your rule is to only take one trade per day, you've got 24 hours to calm down, come back fresh the next day. That's the only way I circumvented that particular problem for myself, because I constantly went on tilt. And this was even when I was getting withdrawals from prop firms and I was profitable. I would still end up blowing accounts because I would lose a trade and then suddenly I'm revenge trading to try and get back. If you just step away and you stick to one trade a day, it fixes it a lot. Okay. So this is my setup. I've shown you guys exactly how I get into a trade. This is how I get into a trade. Okay. But how do I, so like a lot of gurus will show you their setup, right? But there's often a lot of nuances behind the way that people trade. And there's a lot of little details that you have to understand to be able to determine, firstly, whether a trade is actually worth taking or not. Because there's lots of break and retests, right? There's a lot of range breaks. How do I know which zones are the best zones to trade? I'll show you that in this session. I'll show you exactly how to spot the best zones to trade. And then I'm going to show you how to spot the best setups to trade, because you might have a good zone, but the way that the trade sets up on that zone is not optimal. Okay. So when it comes to trading range breakouts, how do I determine a valid zone? So once again, you want to be mindful of the 4-hour time frame when you're getting into trades. Okay. The first thing you're wanting to do is identify V-shaped recoveries, which is simply just areas where price pushed aggressively into and pushed away from. Pushed aggressively into and pushed away from. You can mark them on like this, okay? And then you can link it up to the left with other zones, okay? So you drag the zones to the left, like I've done here. You can see they all link up. This zone here, I just drag to the left. This zone here, I drag to the left, and you can see we've had other reactions. And all this is doing is giving us a framework to trade within. So this is the 4-hour time frame. When we go down to the 5-minute, we'll have these zones that tell us where not to trade into. They're our guidelines. They are our they basically show us what the higher time frame is doing. Okay. You can still just trade this blindly on the 5-minute, by the way, and still be profitable. But if you are aware of the 4-hour, it does help, and it can increase your win rate and keep you out of low probability trades. So here's how to identify the actual 5-minute range to trade. So you can see here, you're going to want to mark the significant V-shaped reactions on either side of price. So we've got price here right now. If we follow price, you can see there's a big reaction here. So we mark it on. There's a reaction here. We can mark it on. There's a reaction here. We can mark it on. There's a reaction here. Mark it on your chart. Same here and same here. Okay. There's lots of them. So how do we decide which of these are valid areas to actually trade from? Okay. It's pretty simple. The first thing you need to ascertain is there a supporting candle, which I like to call the buddy candle? So you can see here, price pushed in, pushed out, and pushed in and pushed out again. So you can see we've got a supporting candle here, supporting candle here. Then we've got this zone down here. There's supporting candles over here, and there's another reaction here. Okay, as opposed to just having a zone that pivots. A zone that pivots would just be one push in and one push out. You can see here we've had multiple pushes in, push out, push in, push out, push in, push out. If it just pivoted, like for example here, and if we look to the left and there was nothing here on the left, it's just a pivot zone and it's not a high quality area to trade from. The next thing we look at is the space from zone to zone. So the space from zone to zone is how we figure out if there's enough space to firstly get to at least 1-to-1 risk reward ratio, where we can go break even or take our full profit. We want at least that. And since our stop loss sizing is between 20 and 30 points, you want to have at least 20 and 30 points from one zone to the next zone. So you can see here from the top of this zone here, we've got basically unlimited, it's open. And from this zone here, it's 40 points. From this zone to this zone, it's 44 points. So basically, you can see there was a reaction here as well. If we look at from here to here, it probably would have been about 5 points. We cannot take a trade from here to here in 5 points. So my zones would be this zone here and this zone here. So I would mark that on the chart. You can see here this yellow box and this yellow box here. Okay, so I would be looking for price to break and close above here or break and close below, and then we can take it to the next zone. Okay, that's exactly how I trade the strategy. So that's how to determine high probability 5-minute zones to trade with. Okay, so if there's enough space to get to break even or a full take profit, this becomes valid. Okay, so you can, as long as you can get a 1-to-1, the zone becomes valid. We want to trade on the extremities of price. Nikhil asks, when a candle closes without a wick, can I re-enter? No. So if a candle breaks and closes below one of these areas, if it does not break and close below, there is no trade. If there is a wick, you cannot enter into a trade. Now, there are confluences that you can look at. So what I've shown you so far is how to identify if a trade is valid or not. Okay. Now, I'm going to show you how to identify the quality of the setup. Okay. So the quality of the setup is determined by 5 different confluences. Okay. The first one is the 50 SMA. We ask ourselves, is the 50 simple moving average trending? Okay. So an example of this is right here. You can see it is clearly trending up. If we're taking buys, that is a good sign for us. The second is the 4-hour zones. Is price inside of a 4-hour zone, or is price within the right amount of space of the zone? Because we do not want to be trading if there is no space available for us to trade. The third is price overextended? So if price has already gone past our zone, if there's a good distance between our entry point and where price is, and we've already passed and it's gone without us, getting in can be risky. The fourth one is, especially on the NASDAQ, is the S&P 500 correlated? Okay. Is the S&P 500 pushing against our analysis, or is it moving with our analysis? I will show you shortly how that all works. I'm going to show you how each of these work. Then we're going to look at, is price imbalanced? Okay, is there an imbalance below our entry or above our entry if we're taking sells? Okay, which can cause us to get taken out prematurely, right? It's very important. And I'm going to go through each of these steps with you guys right now. So we have 5 different criteria here that you can use to get into high probability trades when you're trading breakouts. Okay. And what I do is I like to use what's called the confluence matrix. Now, the confluence matrix is simply, if you've got 5 out of 5 of the confluences, you can risk full risk. It's an A+ setup. If you have 4 out of these 5 setups, 4 out of these 5 confluences, you can go full or half risk. Now, you would go half risk perhaps if you're in a losing streak and you've got 4. I would suggest going half risk. However, if you're currently doing well and you're up on your account, you can still go full risk. A B setup is when there are 3 out of the 5 confluences. It's still a valid trade. But if you are currently in if you're currently in a losing streak, you might want to sit out if it's a B setup. Okay. But if you are doing okay and you've got some buffer on your account, you can take it with half risk. Then if it's a C setup, you've got 2 out of the 5 or less, 2 out of the 5 confluences or less. So you would not trade that. Okay. There's also a bonus, which is the liquidity sweep. If there is a liquidity sweep, meaning if one side of your zone gets swept and it pushes aggressively in the opposite direction, you can put an extra tick here. So basically, if there's a liquidity sweep, a C setup becomes a B setup, and a B setup would become an A setup, and an A setup would become an A+ setup. Okay. So let's go through how each of these confluences work. It's a lot of stuff I'm giving you guys today. This is a lot of value. I'm going through each and every single one of the confluences that I trade every day, which allows me to get into 70+% win rate trades. Okay. So the first is the 50 simple moving average. It's important to add that to your chart. The 50 simple moving average is a very good way to tell the trend. Okay. It is simple, meaning that it doesn't correct often. It's very smooth, right? So you can see here, it doesn't jerk around a whole lot. It just tends to show you a direction quite quickly. So the 2 questions we ask ourselves is the 50 SMA trending over a significant period throughout the day? So I generally look all the way back to Asia and see what direction it's going in. It's either going to be flat, bullish, or bearish. It's easy to find out. And then I ask myself, is the 50 SMA pointing in the direction of the trade? Those are the 2 things, okay? So those are two separate things. Don't get me wrong. Okay. Is the SMA pointing in the direction? And is it trending in the direction? Because it can be pointing downwards, but it could be trending upwards. Okay. So in this example here, we are both trending and pointing upwards. So you can see it's pointing upwards. And it's been, since Tokyo session, it's been trending upward. Okay. So similar for this, okay, it's pointing upward, okay, and if we get a buy setup, then it's in our favor. In this example here, since Tokyo session, we can see price has actually been pushing bearish, and you can see that currently it's curled up and is actually pointing upward. So it's been trending bearish, okay, since Tokyo. So in Tokyo, it was pushing bullish, and now it's pushing bearish, but it has recently started pushing bullish again. So it's trending bearish, but pushing, and it's pointing in a bullish direction. The SMA is pointing up. If I had to draw an arrow here, it would be pushing up, okay? So it's conflicting, okay? So in this case, basically it's null and void, okay? So you can see a price has only just started curling up, even though the 50 SMA has been trending bearish since Tokyo session, okay? So that's important to understand. So you want the 50 SMA to be trending and pointing in the direction of your trade. That's the first confluence to understand. The next confluence I look at is using the 4-hour zones to determine where it's safe to trade. Because if you understand where the safe zones are to trade, you can get into high quality setups. Now, again, a big mistake that traders make is focusing and getting lost in the lower time frames. And this can be done on any time frame. Okay, if you're trading even the 15-minute time frame and you're not looking at the 4-hour or the daily time frame, you are going to get lost in a lot of noise. Similarly, you could be trading the 1-minute time frame. You want to be looking at least at the hourly or the 30-minute time frames. Okay. Everyone trades different strategies, of course, but you'll find that most strategies incorporate higher time frame analysis, or at least multi-time frame analysis, and it's the same for my strategy. So the 4 hours time frame is important. Okay, we ask ourselves two questions: is price inside of a 4-hour zone, or is price within the amount of points that your stop loss is of a zone? Okay. So if you have a 20-point stop loss, you want to make sure that there's enough room to get in and out of that trade, at least at 1-to-1, right? So let's look at a diagram here. So you need to make sure that you're not buying or selling inside of a 4-hour zone. So if you've got your zone drawn up here and you're currently within the zone, you want to be waiting for price to break back into the range or break out of the range, okay? Then if you're within the range or outside of this range here, you're going to want to make sure there is enough room to buy or sell. So if we are down here, we're not going to want to take sells into the zone, okay? We're going to want to take sells away from the zone into the center of the range. Similarly up here. Okay, you're going to want to take sells away from the zone, or you're going to want to wait for price to break through, and then you can take sells again away from the zone. Okay, so that's basically what I was explaining here. Instead, wait for price to break out of these zones, or take trades away and into the middle zones. Okay, if we are within these 4-hour zones, or if there's not enough space for us to get inside of a trade, then this confluence is against us. Okay. The next thing we look at is price overextended? All right. So all we're looking at is, has price reached TP before tagging us in? Or is price close to TP before tagging us in? Those two things are going to be against us. Okay. So if one of these are true, that confluence is against us. So in this example here, you can see price has reached profit target before tagging us into the trade. So here, Okay, and what ends up happening in this example, and this is why I don't get into trades that have already ran to TP before tagging me in. I trade a momentum-based strategy. I want to get in with momentum. I don't want to get in against momentum. I don't trade reversals. I trade continuations. So what that means is I would ideally want price to break and close, tag me in, and continue that trend. What I don't want is price to push up, okay, with momentum, get to my destination already, turn around, and momentum changes. And by the time we get in down here, the momentum has already shifted against us. And what ends up happening there is not enough strength in this zone to bounce it back up. Okay. So what we want to do is catch momentum as it breaks. So as it breaks, we want to get tagged in here and continue. We do not want to now, after it's already gotten to its destination and turned around, try and get in here, because it will have most likely already flipped around on us. Okay. Those are low probability setups. So you can see here in this example, this is exactly what happened. We got to our zone, we got already to the destination, and it turned around on us. Okay. Siggy, if you're having issues, you need to open a support ticket, my friend. This isn't a place for support, unfortunately, bro. So the trade is fully invalidated if price pushes to 150% of profit target before tagging us into the trade. So what that means is that this is 100%. If we get another half, so basically if we get if we basically get this whole length on top, so another stop loss size on top here, then the full trade is invalidated and I won't take that setup. If it has gone to TP and it's gotten close and it takes quite a while to come back, I might still get into this trade with lower risk. It's a confluence. It's not a hard rule, okay, for me. So that is identifying if price is overextended or not. The next is, if you're trading the NASDAQ, the S&P needs to be confluenced with the trade direction you're getting into. That basically means that if you're getting into a bullish trade, you want the S&P to be pushing bullish, and you don't want it to be moving into an area of resistance if you're trying to take a buy. Okay. So basically, if there's a solid area that it's reacting to, and you're trying to get into a buy trade and it's reacting to struggling to break through a resistance, you're going to struggle to fight against that on NASDAQ, because NASDAQ is highly correlated with the S&P. So if the S&P is pushing aggressively to the downside like this, okay, and you're trying to take a buy trade, if you're trying to take a long trade on NASDAQ, the S&P 500 is against you if the S&P 500 is pushing aggressively to the downside like this and you're trying to take a buy, then that confluence is heavily against you, okay? The other is if the S&P is reacting to a 4-hour support zone. So in this example here, this is the S&P 500. It's reacting, okay, on a 4-hour zone. If you're trying to take buys now, it's bad news, okay? The other is if the S&P is reacting to a 5-minute key support zone. It must be a key zone though. So in this example here, you can see this is a significant reaction that happened and we're busy reacting again. So if again on NASDAQ, you're trying to take buys, you're going to get wrecked, okay? What if ES and NQ are going in different directions, or SS? Then you stay out of that trade, okay? It's a lower probability trade. They are highly correlated. If you're trying to get into a buy on NAS, on NQ, you're going to get completely wrecked if S&P is against you. That's why it's one of the most important confluences that I use in my trading. Then the last confluence that I look at is there an imbalance? And this is generally below or above stop loss. So if you're taking a buy trade, you do not want there to be a gap below your stop loss. So in this example, you can see there is no gaps in price under the stop loss. Now, if you guys don't understand what a imbalance or a fair value gap, some people call it, is, go and study it because they are pretty accurate. If you have a gap under price, what's often going to happen is price is going to gravitate to that. So if I had a gap below my stop loss, you'll often find that you get stopped out prematurely and then price goes in your favor. Okay. So understand that you want it to be like this, where there are no gaps that need to be mitigated. It's already been mitigated before you get into the trade. In this example, you can see there are 1, 2, 3 different gaps that need to be mitigated below our stop loss. So what can happen is price can come to retest your zone, and then it can come lower to fill one of these gaps before continuing. Okay. So you want to be mindful of that. So those are the 5 different confluences. So just to recap, the first is the 50 SMA trending in your direction? Okay, so is it trending in your direction, and is it pointing in the direction of the trade? The next is the 4 hours in your favor? Is the 4-hour time frame in your favor? Are you trading into a brick wall on the 4-hour time frame? The next is, when price breaks out, does it overextend first and then change momentum? Basically, when you come back for the retest, is it already changed momentum and pushing aggressively against you? If that's the case, you're going to want to lower risk or stay out of the trade. Next thing you want to look at is the S&P 500 in favor of your trade? Okay, so if you're trying to take buys and it's pushing down, you want to stay out of that trade. Okay, if it is about to react to a 4-hour zone, you want to stay out of that trade. If you're trying to take a buy and it's reacting to a resistance zone on the S&P, then is there an imbalance below your stop loss if you're taking a buy? Is there an imbalance above your stop loss if you're taking a sell trade? Okay, so in this example, you can see here, there are 1, 2, 3 right below here. So when price comes to retest, it is potentially going to come lower and fill these gaps before continuing. Okay, so that's very important to understand, ladies and gentlemen. If you guys have any questions, let me know in the chat. We'll do a 5-minute Q&A real quick. I basically just given you guys my entire system right here on YouTube. Okay. Once you understand these 5 confluences, you can then use those 5 confluences to determine whether the setup is a A+ setup, A setup, B setup, or a C setup. Okay. So once you understand that, if you've got 5 out of 5, it's an A setup. If you've got 4 out of 5, it's A+ setup. If you have 4 out of 5, it's an A setup. If it's a 3 out of 5, it's a B setup. And if it is 2 out of 5, it's a C setup, and you do not want to trade it. If there is a liquidity sweep, meaning one of the sides of your range has been taken out and it pushes aggressively in the other direction and then breaks out, you can add an extra confluence. So a C becomes a B, and a B becomes an A, and an A becomes an A+. Right? So that's exactly how I trade every single day. Karan asks, do I trade ICT? I don't trade ICT. I have traded ICT previously, and I adapted to a much more simplistic system, a much more mechanical system that I trade, where I simply trade breakouts of the range at 9:30 on NQ or NASDAQ, because it simplifies my trading process, which makes it easier on my trading psychology to consistently trade. Okay, because at the end of the day, if you've got a complicated setup, you're going to struggle to stick to it. My question is, how do you handle your emotions if your A+ setup hits stop loss? The way to go around the way to go around taking a loss when you've taken an A+ setup is by having the data with you. Because at the end of the day, if your data suggests that taking A+ setups are going to work for you 80% of the time, then taking that loss isn't a big deal for you because you know that you're likely on the next trade to win once again. Okay. So having the data and the proof to back up your strategy is important for you. Without that, you're trading in the dark. It's like going into a new country with no map. You've got no experience of the track that you are trying to traverse. You don't know where you're going. You're in the dark. It's the same if you're trying to trade a strategy that you have no data with, you've got no experience with it, you're going to be doubtful of every single turn you make. Every single trade you take, you've got no confidence behind it. The best way to become confident at something is to have evidence that it works. Once you have evidence, you have confidence. And when you have confidence in your strategy, all of your trading psychology problems disappear. What timeframes do you use to trade, and what's your advice on news trading with prop firms? So currently, the only two timeframes I use are the 4-hour, which is more of a confluence. I don't actually have strict rules around the 4-hour timeframe. We just went over 4-hour zones. And then I enter trades on the 5-minute. So the 5-minute timeframe is where I enter and analyze most of my setups. The best way to have confidence in summary is to backtest and forward test. Remember, backtesting is valuable. However, forward testing is a lot more valuable because forward testing is actual real market experience and actually going through the emotions of trading, especially if you're doing it on a live account or on a small evaluation account. Because going through the live trades versus doing a simulation is 10 times more valuable because you are actually training that psychological muscle for training, for trading. Which time frame to determine the 50 SM, if the 50 SMA is valid and verify the trend? On the 5-minute time frame. The 4-hour time frame, I don't really look at the 50 SMA. And I don't look at the 15-minute time frame either. All right, guys. So what's going to happen now? We are going to be doing a 50K giveaway. 2 50K Blue Guardian accounts will be given away. What you guys need to do to enter is comment below this video, not in the chat. So not in the chat where you guys are giving questions right now. You need to comment below this video, okay, on what you learned in this video. If you spam multiple comments, you are disqualified. Comment below, and we'll be choosing 2 winners from those comments. All right. If you win, we will reply to your comment. Okay. If we tag you and we reply to you, all you need to do from there is show proof of that and show proof that the account belongs to you to the Blue Guardian support in the Blue Guardian Discord. So you'll go to the Blue Guardian Discord and open up a support ticket where you then show them proof that you won, and then they will grant you your account. So you guys need to comment below this video. Comment, not post in the chat. You need to comment below the YouTube video. And then one of you guys will be chosen, 2 of you guys will be chosen for $50,000 accounts. Okay. So that's it for today's stream. I hope you guys got a lot of value. Honestly, I just went through a lot of information with you guys and basically gave you guys all the source today. So I hope it was valuable to you guys. Really appreciate it, guys. You guys joining in. It's great chatting with you all. I'll see you guys same time, same place next week. We'll go over some more stuff. We'll go over some trades that I've taken this week. Some actual live trade examples. All right, guys. Thanks very much for watching. Make sure to tune in for the rest of the streams throughout this week. Cheers, everyone.